Trading in stocks and other financial instruments can be complicated, but there are tools you can use to simplify the process. One of the most popular tools used by traders is the MACD indicator. In this video, you'll learn what the MACD indicator is and how to use it to make profitable trading decisions. The Moving Average Convergence Divergence, or MACD, is an oscillator indicator used to identify potential buy and sell signals. It consists of two moving averages that cross over one another and a histogram that visualizes when the crossovers occur. By using this indicator, you can spot significant changes in the direction of a security's momentum, helping you to make decisions on when to buy or sell. The MACD is calculated by taking the difference between a 26-day exponential moving average (EMA) and a 12-day EMA. A 9-day EMA of the MACD line is then plotted alongside the MACD line to act as a trigger for buy and sell signals. When the MACD line crosses above the signal line, it indicates a potential buy signal, while when it crosses below, it indicates a potential sell signal. The MACD indicator is a powerful tool for traders because it can help to identify potential buying and selling opportunities in securities. To use the MACD indicator, traders will look for the crossover signals mentioned earlier. When the MACD line crosses above the signal line, it indicates a potential buy signal, and when it crosses below the signal line, it indicates a potential sell signal. It is important to note that while signals like this can provide traders with helpful information, they should not solely rely on them to make trading decisions. The MACD indicator is a powerful tool used by traders to identify potential buy and sell signals. By understanding how the MACD is calculated and how to use it, you'll be able to make smarter trading decisions. Good luck!